All right, let's take a live look at what's happening in trading this morning as we quickly come to the end of the first quarter, which has been a positive one in Toronto and New York. We are seeing some green on the screen, and there's been some increased broadening out, if you will, of buying in the equity market in North America. But let's dig into the numbers now with Ed Clissold. He's Chief U.S. Strategist, Ned Davis Research. Ed, it's great to see you. Hope you're doing well. Tell us right now about how broad a rally we are looking at, because I think most of the conversation up until this point through the lens of the S&P 500 has been, well, it's just these tech companies that are dominating the record high we keep hearing about with the key U.S. benchmark.
Yeah, and we have to remember here, John, that this is a cap-weighted index, meaning that the largest companies are going to have the biggest impact on the total return. And so in any given year, it's not uncommon for a handful of stocks to account for more than half the gains. And that's what we've seen lately. But we don't want to confuse that with thinking that this is a narrow rally. So if you look at, say, percentage of stocks above their 200-day moving averages, which is a common term that technical analysts use to look at the long-term trend, we're looking at over 70% of stocks above their 200 days. Almost 20% of stocks on the New York Stock Exchange made new 52-week highs last week. That's not a narrow market. Now, in early 2000, when the S&P was making a record high, about 30% of stocks are above their 200-day moving averages. That's the kind of divergence we need to be worried about, and it could develop going forward. But as of right now, this is actually a pretty broad advance.
And so what does it tell you when you look at history, when you look at that trend, that you've had a strong start to the year, that you've got more than 70% of the companies in the S&P 500 that have been trading above their 200-day moving averages? What does that tell us when you compare it to history?
Well, market tops usually form when there are what we call divergences, fewer stocks making new highs, a declining percentage of stocks above their moving averages. So when we get this high of a number, it doesn't mean we can't get a pullback. But then you want to watch those pullbacks and see if on the next rally, if fewer stocks are making new highs, those sort of things. Now, we have had 4 months of consecutive gains through February for the S&P. Through the end of the year, when that has happened, the rest of the year has been up every single time by over twice the average gain for the S&P. So pretty good historical perspective there. And we're on the cusp of a fifth consecutive month. And again, the message through the end of the year is strong gains. So momentum leads price is the summary.
Okay, and then when it comes to, we're showing a chart here. The headline is the S&P and the pace of advance in year one of a, call it, slow cycle. Just to broaden that out, that is a chart on a slow easing cycle. Now, just to come back to the interest rate theme that we talk about a lot, and we're going to watch for some inflation data this week. Seems like everybody in the market right now anticipates there will be a pivot of some kind this year. Maybe they recalibrate that math if things change, but there are most market participants think that we will see at least a rate cut or some rate cuts at some point in calendar 2024. Now, the pace of rate cuts is being debated quite vigorously. But if we are moving into an easing cycle that is not a, call it, fast, aggressive easing cycle, what does history tell us about that?
Yeah, slow cycles tend to be bullish for stocks. It's somewhat counterintuitive because if you think the Fed is cutting rates aggressively, 5 or more cuts in a year, then you think, oh, that's great because interest rates are lower. That's going to stimulate demand and growth. But in reality, if you look at those cases, things like starting in 2019, 2001, 2007, the Fed is cutting aggressively because they have to, because they've already made a policy mistake and they're fighting off a recession and usually not doing a very good job of it. Versus a slow cycle, say in 1995 as an example, or 1984, the Fed moves slowly because they can. Because they raised rates to slow the economy, and then they're easing them back down. And so the move from the expectation for 7 rate cuts at the beginning of the year to now it's 2 to 3 actually is consistent with the market rallying like it has. Now, moving forward, the question, I think, is not necessarily is the Fed going to have to panic and cut 7 times or something like that. It's more like, is the Fed going to be able to cut it all? We think they will, but the risk is perhaps if the Fed cuts once and then inflation doesn't continue to moderate and they have to reverse course. There's been a few times that's happened in the 60s, and that's actually been negative for stocks. So I think the risk is that inflation doesn't cool off enough for the Fed to actually go on a true easing cycle.